but everyday consumers are affected because the Federal Reserve interest rate policy influences borrowing costs throughout the entire economy. That is mortgage rates, automobile financing rates, home equity rates, to name a few. You know, when you see that Fed funds target rate rise, you'll start to see other interest rates rise throughout the economy. And basically what the Fed does with the Fed funds rates reverberates throughout both the financial markets and the economy.
So you can see it not just the financial markets, but when you go in to, say, buy a loaf of bread, or if you pull up in front of the gas station there and start pumping gas and you look at the prices of gas, that's all somehow accounted for in the market.
No, exactly, yeah. But you're really going to see it through the transmission of interest rates throughout the economy. If you're going to buy a home, or if you're going to buy a car, or if you're going to get a home equity loan, as the Fed starts to raise rates, you're going to see the rates on those instruments rise.
Let's talk about if rates if low rates are good, why not keep them low forever?
Yeah, in fact, I've answered this question a few times. The problem is that lower interest rates can also lead to inflation. The Fed really is balancing the positive effects of lower interest rates, that is economic growth, versus the deleterious effects of lower interest rates, and that is potential inflation. And, you know, just like the fairy tale of Goldilocks and the Three Bears, the Fed wants the proper balance between economic growth and inflation. The Fed tries to get that balance just right, and that's the key, the key to Fed policy. And it's done, you know, it's not a one-to-one relationship. The Fed is picking up signals from the marketplace, then changing policy. That policy then has to work its way through the economy, and sometimes, quite frankly, they get it wrong.
How would a rate hike affect different asset classes?
Well, as I just noted, stocks perform much better in a falling rate environment than a rising rate environment. What we found, interestingly enough, was the returns to government bonds aren't much different in different interest rate environments. Now, the return to high-grade corporate bonds are better in falling rate environments than in rising rate environments. If you go further out on the credit spectrum, the returns to junk bonds or high-yield bonds are much better in falling rate environments than in rising rate environments. And that makes sense because junk bonds are kind of a hybrid between equity and debt. Real estate, interestingly enough, does much better in falling rate environments than rising rate environments. Yet real estate investment trusts kind of hold their own when rates are rising. In fact, real estate investment trusts, equity real estate investment trusts, earned about 10% compounded annually when rates were rising, which is much better than the S&P.
Absolutely, and real estate would fall in possibly its own either alternatives or its own asset class, and so that's something to, because usually people will seek these alternatives if the market's down, and it's interesting that some of these things, adding the rising rates and the lowering rates to how it actually affects them is a very, very interesting way to look at it. If we drill down a little bit further into sectors, what sectors would benefit the most from rising interest rates?
Well, not stock market sectors, but I want to get back to your point on alternatives, because commodities are one asset class that does much better when rates are rising. We found that a broad commodity index returned 17.6% when rates were rising and actually lost 0.2% when rates were falling. And that gets back to the inflation element, is that a lot of times commodities are tied to inflation. On the other hand, gold didn't do very well across all interest rate environments, and I find that really curious because gold is often touted as a safe haven.
Right.
Gold provided fairly pedestrian returns across all interest rate environments, and in fact, Chris, during rising rate environments, the return to gold was less than the inflation rate.